This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. Are we good now? Oh, I think we're good now. What's up, Zane? I just said like a bunch of really cool stuff, actually. Some great trade ideas. You guys all would have became millionaires if you could have heard what I just said the past like 5 minutes, but I guess now we'll just start over. So anyway, looking at Tesla stock that was just on my Benzinga Pro that I pulled up from yesterday. Trading lower off of the open. We're basically right back to yesterday's close. I will be waiting. I think Tesla's earnings report tomorrow afternoon will be start over. I wish. I don't know. I mean, oh man, I realized what I guess I could have done was puts on Tesla. Anyway, so the company, if you guys remember, Tesla a couple weeks ago, and we can see this on the daily chart. I want to say this was about, I don't know, when was that? Let's figure it out. I don't want to get this wrong. Tesla deliveries. That day, Tesla missed deliveries for like the first time ever. So here's the thing with Tesla is right now, Tesla is still overvalued from a lot of fundamental stock metrics, right? Whether you're looking at the PE, whether you're looking at the price to sales. With that said, Tesla has had actually incredible growth in terms of obviously, you know, market share, reach, deliveries, all these things. But most importantly, revenue. And when you see that revenue growing quarter over quarter, year over year, people are willing to pay a higher premium. I think tomorrow's earnings report, tomorrow afternoon, will be a good indicator of is Tesla able to continue that type of growth? Is it able to maintain that type of growth in adverse environment, in an adverse growth environment as rates are rising, right? It's going to make, it makes, you know, growing the business harder, borrowing money, all these things harder to do. You've heard Elon Musk come out and say, yeah, these next quarters are going to be tough, right? The Gigafactory in Berlin is going through growing pains, all these things. And with that said, there is, if you're a huge Tesla investor, light on the other side of the tunnel where at the end of the day, no matter how bad the current environment is for growth companies, you can lean on, you know, the Inflation Reduction Act and these things and government and say, okay, we know that there's going to be help coming in from the government side. There's all these things to promote electric vehicles and clean energy. Tesla's going to benefit from all this. So I do think there's a good bull case for Tesla from here if you can make the argument that it's able to withstand a high interest rate environment and added competition and all these things, a Twitter distraction to Elon Musk. Like, if you can make the argument that Tesla's going to be fine through all those things, and like I said, see those benefits from the government subsidies, from the government funding on the other side, I do think there's a legitimate bull case to be made for Tesla. Now, with that said, in the short term and interim, I'm not interested in owning the stock right now. If you had to tell me I had to be either long or short the stock the next 3 months, the next 6 months, I'd probably stay short. Because I don't think that there is going to be any, you know, I'd be shocked if tomorrow the company reports just, you know, record number. Honestly, what? For all the time I've never heard it speak. We'll find some nice juicy rounding about. There was one on the other day on the show where I was like, hey, if you watch Get Technical, you know what we're looking at here. I forget what it was. I don't know. I'm not gonna go back and watch all the game tape from the past shows the last like 2 weeks, but Tiny Pie, there was one where we found a rounding bottom. I can't remember what stock it was on now. I'll keep. I know there are a few. BTU comes to mind, but I think that one's pretty much played out. This was a nice rounding bottom that we called out. What was the one that was like recent? Someone help me out here. There's one that it was setting up for a nice. I don't think it was ARC. No, see, that's not a nice rounding bottom. Array had one, but I think that one's kind of played out. Yeah, it's not even that rounded. What was it? It's killing me. Coinbase, maybe? It might have been Coinbase. Kinda. Yeah, I mean, it's not as round as you would like it, although I think most charts now have this little where we really gapped up and actually it yeah, and then gave up most of those gains. But without that like gap up in mid-August where it looked like a soft landing was possible, this would be kind of a nice rounding bottom. I don't really like I don't know. Is Steven Collation coming on? No, Mr. Collation usually comes on Thursday. Did SPY start to pivot again? Ooh, we did start to come back up on the S&P 500. This is the 5-minute chart here. I mean, you can see this was a ugly like 10 minutes from 11 a.m. to about 11:20. The S&P 500 went from 371 down to 369, dropped a couple bucks there in just 10 minutes or so. But I don't know. I mean, guys, look, we're going to have big earnings still the rest of this week. You have, of course, Tesla. We have IBM. We have Johnson & Johnson. All these companies. Who was it? Goldman Sachs reported this morning. Yeah. And I think they were good. Obviously, the stock's up like 2.5%. I don't think they were, you know, something absolutely crazy, incredible, amazing. We can go into our overview right here in Benzinga Pro. Scroll right down to this morning. You can see on the newswire. So looks like revenue beat by about 450 million. So remember that yesterday, Bank of America beat by nearly $1 billion. That kind of sets the bar high for banks across the board, I'd imagine. Who else? I'm missing a big earnings report this week. Oh, Netflix, of course. So Netflix, I get the feeling that the trade's kind of crowded at this point. I mean, we went through it the other day, but at this point, Netflix off the lows back in like June is up more than 40%, has really been outperforming the market the last 3 months or so. I wouldn't be surprised actually if the stock came down a little bit after earnings. Although there is, if they come out and say like the quarter might not have been that terrible, and then if they also say, by the way, the advertising tier revenue or the advertising tier model we're starting for Netflix, we expect to make X amount of money. The bar is just super low for Netflix at this point. I wouldn't be absolutely shocked to see, the stock moving higher after earnings. But like I said, I think that the long Netflix trade in the short term has gotten a little crowded. So I'm hands off. I'm on the sideline going into Netflix's earnings tonight. I'm telling you what, if the stock moves lower, I'm definitely going to be interested in going long, getting at a nice point. And if the stock moves higher, guess what? I'll still be interested in going long because that will give me confidence and conviction that, okay, now investors see that this company, is going in the right direction, isn't on this downward spiral that it was on, losing subscribers, all these things. And we'll see. And I also remember gave that, kind of out of the box bull case for Netflix is that if we do have some sort of widespread, economic recession, I think Netflix is a stock that actually is able to hold up in that environment because people aren't going to cancel their Netflix subscription. Because if you're trying to save money, you're trying to go out less, you're trying to go out to restaurants less, you're trying to travel less, you're trying to actually save money, a $15 subscription a month service that gives you hours and hours and hours of tens and thousands of hours of entertainment, then that actually ends up helping you save money. Is this just a normal pullback and taking profits, or did something happen for this drop today? So good news for you is we're on Benzinga Pro with our advanced news feed. So typically, there's typically usually midday. Unless the Fed comes out as speaking, it's rare that there's like one headline that just rocks the whole market. I shouldn't say rare. I don't think it happens on like most days. Missouri announced it. Sorry, I just saw Missouri in the newsfeed. It pulled $500 million in state pensions funds from BlackRock. Is that bad? Good? It doesn't sound good. I think this is just normal profit. I mean, look, we were up like 2.5% yesterday on the S&P 500. I want to see exactly what we were. I think, too, a lot of people are in this zone where things have been very volatile, where we've kind of been up, a lot one day, giving up gains a lot. So people are timid right now. I think, yesterday we closed up 2.5%, went up another, so it doesn't surprise me to see a little pullback here. Again, I think this earnings week will be really important for the overall market. Yes, please smack it a like. Jason Raznick in the chat continues by Hub. We can talk about HubSpot. I haven't looked at HubSpot in a while, but this has been probably the most, if you're looking for a beaten up area to go shopping in, B2B SaaS companies it has to be up there at the top of the most beaten down names out there, whether you're looking at your Asanas, your HubSpots, your Bill.coms. What one has been really ugly has been DocuSign. Look at this one. Look at DocuSign, just been freaking terrible. I don't know if you guys saw this. I think it was on like Twitter or TikTok. Someone made a video of how you can sign documents using your iPhone, and someone made like a joke on Twitter about like, okay, and just like that, after this video, DocuSign's market cap is going to get like cut in half. And DocuSign tweeted back at it and was basically like, here's why you shouldn't, sign this. You shouldn't sign using your iPhone. You need to use DocuSign, whatever. And I was kind of calling BS on that because if you have to sign something for, work or I guess there are a lot of cases where if you needed to and you needed to go back and have some like legal, but I would say in 99% of cases, if you're signing something, whether you do it, like whether you actually just sign it, if you just sign it on paper, right, you're not going to have that same legal thing that, legal backing that DocuSign has. Here, let me find the exact tweet because it shouldn't be too hard. Unless they're super active on Twitter. I'll try to find this. But yeah, basically my thought process on it is in 99% of cases you are fine just signing something. Like I've never in my life I've signed a lot of things. I've never in my life like ever had it. I don't know. I guess it should. Oh, here we go. I found it. Found it. This one of my best. It's all about the authentication. See, but that's what I'm saying. I don't necessarily agree. I guess like in my life, and I would completely, like, my mind would be changed if I ever signed something and then someone came back and like tried to argue with me illegally and say I didn't really sign it or something. I don't know, but I'm just saying I've never had a case in my life where I've had to sign something and then needed some authentication. I don't really know. All right, so here's the tweet. So this is how you can scan and sign documents with an iPhone. So basically just like all of DocuSign's business is a software that allows you to very easily electronically sign something. But to DocuSign's point is it has all these legal, workings in it to make the signature legitimate, whatever. Senior PowerPoint engineer on Twitter who I don't know if I can recommend him as a follow on Twitter because he might have some like raunchy tweets, but I personally follow him from my personal Twitter account. I think he's a good follow. He said, "Oh no, my publicly traded company with 6,000 employees is going to go bankrupt because of UCLA comp sci students' summer Apple internship project. RIP DocuSign." So basically, senior PowerPoint engineer is just saying, "Hey, this whole company's business is based off this one software that is now essentially." Oh man. All right, I just got a text from David Green. Will officially not be joining. Hopefully everything's okay there. So, basically their whole thing is built on this software to be able to easily sign something. If you can do it from your iPhone, it's like how, I don't know. I can't think of a good example of Apple's done this before, but take a company, like I know they bought Shazam, but the app Shazam where you would have to, you would use it to listen to a song and it would tell you what song it is. If Apple just gave their iPhone the ability to do that and didn't buy Shazam or whatever, Shazam instantly overnight becomes an obsolete company. Why would you need to download the app if it's built into your phone? So why would you need to use DocuSign if you can do it on your phone? DocuSign responds to it. Funny, not funny. Please don't use this for any real business agreements. Contracts signed with e-signature come with a secure electronic record. Backend technology records the IP address of the signer, as well as the date and time the document was signed. So again, I might be being stupid here, and you can say like, "Oh, Aaron, you're being really dumb." I think my point stands, and you probably want the protection, right? It's like you could make the same argument for insurance, right? You drive 99.9% of the time and are fine, but for the 0.1% of the time, you want that insurance. I don't think it's typical. Well, okay. With that said, DocuSign is not the only player in the game. Yeah, I know Adobe has a competing software. But here's the thing, is even if someone like disputed a signature that you did from your iPhone, and then there was this whole dispute over it, like, and it went to court, like, would they say that it's not legally binding if you sign it from an iPhone and you did on DocuSign? I don't know. I don't know these things. Again, like I said in the insurance example, I get it. I get the value in having the security, the you have the I guess like peace of mind when you use DocuSign, but 99.9% of the time I don't think it would matter. I think whether you sign it in person without a notary or something, or you sign it on your iPhone, I think a signature is a signature, and it comes back. MD is saying DocuSign's right. I'm not saying they're right or wrong. Obviously, the company got, or at least their social media manager, a person running their Twitter, got frazzled enough to need to respond to that. So I thought it was just kind of funny there. But again, back to my point, the B2B SaaS companies have been getting beaten up. If you've got a name like Jason has in HubSpot that you like long-term, not a bad time to start picking at some of them. When they're down, I mean, let's take HubSpot, for example. HubSpot stock is down. Take a guess. I'm going to guess anywhere without checking. I'm going to guess somewhere between 70 and 75%. All right, it's down 66% right now. So you went from, let's go back to HubSpot. Went from 860 down here to 270. Let's go over to our overview. I like to just check. So, all right, PE super high. You know, I think a lot B2B SaaS companies like these things. Okay, $13 billion. So smaller market cap compared to, you know, your Salesforce, but pretty big when it comes to different B2B SaaS companies. Let's check over here on the financials. I want to go straight to the income statement. I'm going to go ahead and give me a zoom here, a couple of them, so we can get those numbers a little prettier for you. All right. All right, let's look at annual first because I'll go broad. Okay, so this is great. This is great. All right. Annual gross profit. This is in millions. So they went from, or HubSpot went from 400 million, 540. That alone would be good growth. You know, almost a quarter, 25% profit growth. But then look at this. You go from 544 to 716 to a billion. So gross profit really going up there. I like that. I like to see that. We'll go to quarterly to check it over the past few quarters. Certainly you're still seeing quarter over quarter growth. I think, I mean, especially in this environment, this is kind of the what's the good saying, like when the tide gets tough, the tough get going, something like that. You know, it's like, this is, if you find a company that's able to get good returns like in this environment, good growth in this environment, that's how you know you're really found a winner. So let's see when HubSpot reports next. And I might be following Jason in on this one. 11-2. If they someone remind me, someone put a reminder in their cell phone. What's 11-2? 11-2 is a Wednesday. Here, I'll do it. Is it pre-market? After-market close. All right. All right. Hey Siri. Hold on. Hey Siri. Hey Siri, are you there?
I'm sorry, I didn't quite catch that. Could you please say that again?
Hey Siri, are you there? Okay, can you please remind me at 8:30 a.m. Eastern on November 3rd, 2022 to look at HubSpot's earnings from the previous afternoon, and if they are good, buy the stock. All right. Reminder, 8:30 a.m., 11/3/22. Look at HubSpot earnings from the previous afternoon. If they are good, buy the stock. All right. Good. Good job, Siri. That's my virtual assistant right there. In fact, there are still a lot of companies that won't do a digital signature. Again, I get DocuSign's point. I just think 99% of the time that if you sign something using your iPhone, you'll be fine. Someone's gonna like listen to me on that and sign something with their iPhone, and their whole, you know, it's gonna be like one of those, like, I guess like Seinfeld episode where someone's whole life gets like ruined because George told them they didn't need to sign something, and then, you know, they come back. I don't know. All right, guys. So no David Green. We're not gonna do any live trading. Let me know in the chat what stocks you guys are watching if you've got any trade ideas. I do think right now we talked about really beating up B2B SaaS companies. Does anyone have any favorite ones, by the way? Because they're all beaten up. Whether you're looking at Asana's, whether you're looking at DocuSigns, this is one of those ones where I got really I got caught up after I forget when I bought DocuSign. I bought it, I think maybe like here, right after one of the really bad earnings reports. I got out of it really quickly, so it was bad on my front for thinking. I think it was like a value trap scenario where the PE was low, but then let me see if their income or gross profit actually has come down. Yeah, I mean, you can see here the growth has been pretty stagnant, so we're looking just at quarterly growth here. This is gross profit, 430, 450, 456, 485. So it is growing. The profit's growing quarter over quarter, just not at the rate that it was. And you can see the cost of revenue has also been going up. So 115, 130, 132. So I don't know. I mean, I'm not saying DocuSign's a sell here. I think it's still beaten up. It probably, I mean, yeah, at this point, the forward PE is 25. Price of sales is still 4. So some people, you could still argue it's still expensive, but it's still probably considered a growth stock. I'm not that interested into it. It's kind of, to me, it's a one-trick pony. And now there are other people in the game, like Adobe has a competing service. I do think, so out of the companies that we use here at Benzinga, that we are customers of, HubSpot is one that I personally use, and we use it like every day. I don't think we could go without HubSpot. We certainly couldn't go without Salesforce, who of course also owns and operates Slack, which is huge. But again, like Slack and Salesforce are great, but Microsoft does a lot of that stuff, and then also has like a million other things. So you could have exposure to the similar field in Microsoft, and then have other things too. It should be worth mentioning, I know Microsoft confirmed layoffs yesterday. As we can see here, the stock isn't really getting beaten up over it. And that's the thing. I guess like that's the whole, I think, bull case on big tech right here, is you could tell the market, yeah, Microsoft's laying people off, and the market would say, yeah, that makes sense. The stock's down 30%. We kind of anticipated that. You know, we've been selling the stock more than we've been buying it, and you know, we anticipated layoffs, so the stock's been trading down. Okay, great. You know, Xbox sales might be weaker this holiday season, and the traders on Wall Street would be like, yeah, you know, this whole holiday, you know, we're expecting the whole holiday season to be a slight downturn, so we priced that in. You know, essentially that just every big bearish headline you could give me about Microsoft, the market's aware of, the traders on Wall Street are aware of, and have been pricing this in, not just the last 3 months, not the last, you know, even 6 months, but since last December, since the beginning of the year, been pricing in a higher interest rate environment, growth's not going to be there, you know, all of these things. So again, Microsoft reports in 7 days, certainly things to look toward there. Because I'm not saying there's nowhere to fall, because there certainly is. And especially with the bar lowered into an earnings, that's kind of a two-sided sword, because on the bullish side, if they report just an okay quarter, the stock can respond well, or if a good quarter, the stock really takes off because it's been beaten down. But the other side of that sword is that with a low bar, if you miss that low bar, then it's wheels off. And that's what we saw with, you know, Meta or Facebook, whatever you want to call it, on its really, really bad earnings report, when what was it, down 26%. I think that was the most market cap of a single stock wiped out in any like 24-hour period in human history. Literally, I don't know, someone do the math on this for me. So what, the day before we were closed at 323. The next day we closed at 237, so 323, so $95 right there. Or wait, is that right? What did I say it was? 323, 327. $323. All right. I know. So $85. So it dropped $85 overnight. I don't know. Someone can do the math and figure out how many billions of dollars that is just in market cap, just like completely obliterated overnight. Question: I'm new to Benzinga. What is the symbol for the S&P 5 index? On my brokerage, it's the SPX. So there are a few. I think you can look at the SPX on here. Can you not? No, I guess not. I would just look at SPY then. It'll be pretty much the same. So the S&P 500 is, what is the S&P 500? I don't even know. It's just a collection of companies. It's an index. The actual ETF from Spider is the SPY. We talked about this the other day. VU is also an ETF of the same ones. but it's priced a little. So the cool thing about SPY is it's basically 1/10 of the actual S&P 500 composite. For example, like I, I don't know. I honestly don't know how to. I don't know how. So the actual index is. So I don't know where the SPX comes from. Let's see. Yeah, so the SPX is the actual. Well, I just had a little weird voice crack. I don't think. I think the SPX is the actual index that comes from Standard and Poor. I don't think we get that on Benzinga Pro. But you can see here. So the S&P 500 is 3710 right now. Well, we'll call it 3711. The SPY is 37. Like it might lag it a little bit, but it'll be 37.1. 11.2 here in a second. So it's basically just 1/10 of the actual index. For some reason, VU, like this was kind of confusing to me, is like VU's 340. So that makes like it's off. It doesn't track it the same way the SPY does, but it should be percentage wise. Look, the VU's up 0.92% today. The SPY is up 0.9, 0.8. Like they're always going to be pretty similar. So if SPX is not in Benzinga Pro, I would just use SPY and know that the index should be about 10 times that. Oh, Jay Rice, that's a great great call on kind of a bearish bull case on DocuSign. Is that two industries that it's huge in, real estate and the mortgage biz, not the place to be with high interest rates. How's, by the way, I want to know, someone find me a housing expert to bring on the show. Because Zillow, I know Zillow, you can like just go on Zillow and they have different housing reports. I mean, obviously, like, different companies, mortgage rates raised the 20-year high, declining demand drives price pullback. So like, I want to see what I'm curious about is like the average amount of days listed on a house. I think like that those are skyrocketing up. All right, housing demand has fallen by more than 30% in last year nationally. So almost down to COVID low. Man, see, that's weird. At this time, May 2020, I feel like every single person ever was building a house or like renovating their house. Yeah, this is actually really cool from Zillow. Is Zillow publicly traded? Stephen Thomas, he's an housing expert. All right, Brett, use SPY for now. I'll figure out why we don't have the actual indices on the Benzinga Pro. I'm trying to. We might get some commodity prices on there as well. I just don't know. We don't have that many actual commodity traders, but we have people that like to check, price of oil, all these things. I could care less. Market reports. Home price declines moderated in September thanks to temporary mortgage rate relief. I wonder what the CME watch tool says. I bet it's like 100% that we're gonna see. See, I thought there was a chance we would get a full percent. Apparently not. All right, next FOMC coming in 15 days. Yeah, 95%. Oh wow. Look at this. Here's something the mainstream media won't tell you. According to CME, the odds have more than doubled in the last day that we'll get only a 0.5 point rate hike at the next FOMC. So yesterday it was a 2.1% chance. Today it's more than a 4.5% chance. So you're telling me there's a chance we only get 50 beeps instead of 75 beeps. Deflation is starting and recession will increase. This will be far worse than inflation. Yeah, I mean, I don't know. You can't. I don't really know what to tell you. There is an argument about how deflation's really bad, especially for in market terms, because if you think about in terms of earnings for companies, if you take an Apple, for example, if Apple's selling every laptop at $2,000 and deflation kicks in and then they start selling them for $1,800 and sell the exact same amount of laptops, or maybe even a few more than previous quarters, their earnings are going to get hit. Going to look like the company's going to make less money from quarter over quarter because of deflation, and the stock price is going to go down. Someone asked how we can read this. All right. So, full disclosure, I understand it. I think kind of intuitively. I don't really know why it's this way. But the current rate, they always show in a range from 300, from like a 25 basis point range. All right, so let's start with basis points. If I say basis points, bips, beeps, BPS, all mean the same things. Basis points are just 1/100ths of a percentage point for the interest rates. So if interest rates were going to go from 1 to 2, if Fed's raising the interest rates from 1 to 2, a full percent, that'd be 100 beeps, 100 basis points. A basis point is just 1/100th of a percent. 100 beeps equals 1%. I don't know why that's the preferred way to talk about it, but it is. So it's always given in a range. We'll start there because I know one time when Spencer was still here, he was misreading it based on the range. So right here in the chart, and the data is the same right here in the chart and the table. It's just based on how you want to read it. It's going to show us. It's giving us two different options for the next federal meeting when they're going to announce the next rate. They're saying after the next meeting, the federal fund futures Fed rate is going to be in the range of 350 to 375. So given our current range up here of 300 to 325, 350 to 375 would equate to a 50 basis point increase. That would be a 50 basis point increase. On the flip side, if we end up in the 375 to 400 beeps range, that would be a 75 beeps raise or a 0.75% interest rate. So the reason we care about this as traders is because obviously if the Fed comes out and surprises everyone and says, okay, we're going to do 0.5% instead of 75 beeps, the market's probably going to rip off that. People are going to see that as dovish. Conversely, if they come out and say 75, there's a chance the market goes down. There's a chance the market goes up because it was already priced in if they go a full percent. But that's basically why we care. Then down here, what I was looking at earlier, it shows the same data, so 4.6% that we're in this range. It's giving a 0% chance rate for a full percent, which I think is notable. It shows us the percentages that they're giving now, the percentages of a day ago, the percentages of a week ago, and the percentages of a month ago. So a month ago, it looked like about a 1 in 3 shot that we were going to get only 50 basis points, that those chances dwindled almost in half. A week ago, a day ago, 2.1%, but now trending back up. Yeah, and on the deflation front, there have been a few people that have talked a lot about it and what it means for what deflation means, like overall for an economy. You know, Kathy Wood talks a lot about it, and you know, I don't think at this point, I think, you know, that whoever was talking about deflation in the chat, I think the top worry still for us as investors, for us as consumers, for us as like everyday people that live in a society, inflation's still the fear here. I don't think we're in an environment where we can start to fear deflation yet. We should welcome all the deflation we can get until inflation is quelled, and then we can go back to start worrying about deflation. Yeah, no problem, Jose. And then if you want to go actually in the weeds and figure out how they calculate this, they have a whole tab on the methodology here, and it's using different, futures markets, federal funds effective rate, all these things to calculate the odds. So I don't know. This is for if you're a super big, statistics nerds and you want the P-score and this and that, I couldn't. I don't know, man. I mean, I trust the numbers they give me. That's probably my biggest fault. Is I just trust the numbers. There was an interesting argument, kind of investing related, markets related, definitely political, where I saw people on Twitter arguing DG was unable to come on. Yeah, sorry. No, 100%, guys. And if I ever bring up a tool or data that someone wants, clarification on, please do, because like something like that, I could understand how I would like pull up the CME watch tool and someone not have any idea the importance of it, why we're checking it, why it matters, how they get the number, all these things. So always ask in the chat. We can go through some of those things, because frankly, it helps me as well. Anyway, this political argument, it was about the UK situation and basically saying, someone was basically talking about how they didn't like how essentially the markets, the investing world, could reject a political measure essentially to the point where the politician then has to change because what the market's doing. I was like, I feel like that's just a free market. Like they're just gonna do what they do, right? Like the stock market's gonna do what the stock market does. So if the stock market starts tanking to a point where people's pensions are in trouble and the Fed has to pivot, you can't say like, oh, that's Wall Street trying to flex and get the Fed to do what it's gonna do. Honestly, you can't, like, I think some people do think that way, that they think, okay, like I honestly don't know. Like they think like, oh, Wall Street's gonna tank the market, so the Fed has to pivot, and then Wall Street will be happy that the Fed's pivoted, and then the stocks will go back. It all just seems so backwards to me, like that thinking. If interest rates go up, we will just start saving money instead of spending money. Interest rates going up, that will discourage borrowing too. Less spending equals less demand. Prices will go down. I think you cracked the code. Well, I don't know what Austin, Dallas worth. ADW, Austin, Dallas worth, Texas. If interest rates go up, we will just start saving money instead of spending money. Interest rates going up, that will discourage. So, all right. I don't think savings increase when interest rates go up. I think they actually decrease. I don't know. Could be wrong. Do savings go up in high interest rate environments? Either way, interest rates going up, that will discourage borrowing too. 100% factual. Less spending equals less demand. Potentially. Prices will go down. They should, at least in certain areas. But yeah, I think you cracked the code. Well, I know it's Texas, but I'm saying I don't know what the ADW is. If it was DTW, I know it's, or DFW, I know it's Dallas Fort Worth. But yeah, that's the goal here. That's what the Fed's trying to do: raise interest rates so prices go down. Critics would say that raising interest rates isn't going to do anything to bring down the prices in certain goods, whatever, and could potentially even make things more expensive. You could also make the argument we're seeing prices coming down. How much of that is actually from the interest rates rising versus how much of that is from certain supply chain things getting normalized? Who knows exactly? I mean, maybe we'll know in all due time. The bottom line is it looks like inflation is starting to come down, whether that's because of the interest rates rising or not, happens to coincide with them. The Fed will continue to raise interest rates until one of either two things happens. The first is something essentially breaking in the financial world or approaching that. And that could be different degrees, right? We saw Credit Suisse almost collapse a couple weeks ago. It could be, a big bank being on the brink of something, or it could be something like, okay, a lot of the U.S. pensions in different states are under a lot of pressure, getting really close. The market's now down 35%. I don't think it has to be a scenario where you have this like super bit, a big short moment, essentially, where you have a Lehman Brothers type situation. I don't think you necessarily need that. I think you just need a worsening market conditions to a point where something like that looks likely, and then the Fed would be forced to pivot. Or number two, inflation comes, under control or well, on its way to the 2% goal from the Fed. I think out of those two things, number one is we're way closer to, happening. I don't think we're close to inflation being, remotely near that 2% level. So we'll keep watching that. CEO of a big bank in interviews saying that people doubling, tripling on credit card payments, then the bank makes less money. I don't know. I'm confused here. So you're saying because interest rate goes up, that would mean credit card payments would go up. So people have less incentive to so they're paying more. I would think in a high interest rate environment, people are making less, people are spending more on their credit cards, that credit actually goes up, not down in a high interest rate environment. Would be just my guess, and I have no clue what I'm talking about. Some companies will be filing bankruptcies and some will be fine. So we need to be a company's debts now. How are they paying the debts? Yeah, 100%. The B of A guy, what a liar face. The what's his name? Brian Moynihan. I hate that I know that. Out of all the random things to know in the world, all the different tidbits and beautiful things that I could be hosting in my brain of knowledge, I know who the Bank of America CEO is. It's not even like Jamie Dimon. Like, who cares about Brian Moynihan? Emperor Xi holding on tight to zero COVID policy, and good. At least someone's taking it seriously. No, I'm just kidding. That's my bank teller. Moynihan. I saw someone else, like, I don't know if it was just on Twitter, maybe it was like a baseball player. I don't know. I saw someone else with the last name Moynihan on like Twitter or something, and I was thinking about how it was same name as the Bank of America guy. Corporate profits are at all-time highs. They're addicted to the yeah. Yeah. Are we possibly going through a dead cat bounce? It's a great question. I don't know. To be honest with you, is like the real answer to that question. I wouldn't call this market like a dead cat though. Like I think we've got some life. I think we've got some signs of life here. I don't think it's just again, in my whole thing, and I sound like a broken record, I know. But my whole thing is that I don't think there's a lot of major macro headwinds, bearish catalysts that the market hasn't already, if not fully priced in, the majority priced in, right? Like even a really weak earnings season across the board. Like I don't know if that brings the S&P another 10% lower. We're already 30% off the highs. And you could say, okay, Aaron, we're 30% off the highs, but I don't think going from the highs is a great way because, and sure, that might be fair. Fine, you don't want to go from the highs? Let's go from here. Let's go from 453 on September 2nd, 2021. So we're not going from the all-time highs when we might have been frothy. So if we go back from September 2021 to now, we're still down nearly 20%. And I know that's not a good investing mindset. Oh, we're down X amount, which means we have to. But I mean, we have a pretty. It's not a very small sample size. We have a very long history showing us that the S&P 500 goes up over time. Not just a couple percent, but about 9% a year, right? So I don't know. I mean, like I said, I think a lot of this stuff has been priced in. There are certainly things that can happen to drive us the next leg lower, right? If things are going on with the war in Russia and Ukraine, if inflation continues to worsen, if things in China, all these things can happen. But I'm just looking at the current landscape of what's going on from a macro perspective, what's going on here in the U.S., what's going on at individual companies. I would say 80 to 80. I would say 80 to 90% of all bearish, things that are impacting stocks right now have been priced in. There might be we might be a move a little bit lower, but kind of feels like it. I don't know. Oh, the dead cat bounce, opening high, fading to. Yeah, today's price action has been, if you're super bullish, has been bad. I'm not, I wouldn't say super bullish right now. I'm kind of, I would say pretty neutral. I'm more bullish than I think the average person is right now. But I'm kind of just I think the most likely scenario, at least in the S&P 500, is that we trade sideways for a little bit before we get some conviction one way or the other. The biggest thing I think we have to realize now is there still is a shit ton of cash on the sideline when it comes to institutions. So Moynihan Train Hall. I don't know where I saw the name. I forget where. I think it literally might have just been someone's name on Twitter or something, for all I know. Someone's real name just happened to be Moynihan, and I was like, oh, interesting. That's the Bank of America guy's name. And then I was like, oh god, I hate that I know that. There's a shit ton of money on the sideline from institutions. I don't know what needs to happen to get some of that money off the sidelines. Maybe earnings. Maybe some of these companies reporting earnings the next month will say, hey, yeah, the environment hasn't been great. We didn't put up as much money as we thought we were going to initially, but we still put up this amount. And they're like, oh, wow, that's actually more than we thought you were going to. And then some of this money starts coming in off the sideline. I don't know. I don't know. I think I believe it was Andy O in the chat said opening high, fading throughout the day. Like he said, that's not a great sign that we opened about 2% higher on the S&P 500 today. Looking at the 5-minute chart, you can see, oh, what happened to that? I kind of like that it was doing that, giving me the sections of one set. It showed me what was pre-market and what was anyway. Here is when the market opened. Basically, we've been going straight down on the S&P 500 since we opened. So, we can look at some of the individual stocks we were looking at. Your Tesla. Oof. Tesla on the 5-minute chart. I mean, yeah, you can look at Tesla here. We're moving higher, blah, blah, blah. But yeah, we'll see. The only thing I would disagree with dead cat bounce about, because I'm pretty sure dead cat bounce more refers to all right, in finance, a dead cat bounce is a small brief recovery in the price of a declining stock, derived from the idea that even a dead cat will bounce if it falls. Oof. Even a dead cat will bounce if it falls from. Is that true? The only, and I'm not saying I don't think we're still in a bear market, because I think we are. I think you would typically call a bear a dead cat bounce in a market that really has another leg, to move lower. And I don't know if I really agree. I guess you would still I guess if the S&P 500 went my bear case is down here. The S&P comes down to the 3,300 level. So I guess, yeah, bounce from yesterday today, you could consider a dead cat bounce, 100%. We'll see. We'll see how today closes up. Certainly, if we go green to red today, that would be a bad sign for the S&P 500 and for the overall market. But as it stands now, the S&P 500 is back up almost a full percent right now. The last three inflation 8.1, 8.3, 8.2. So has inflation peaked, or is it now entrenched? So I think we're seeing a lot of sticky inflation. But let's keep in mind that if the prices we have right now, like I think still when you look back at it, last month's CPI, yes, it was up year over year. I think core CPI month to month might have been down or not. I don't know. Either way, if it is entrenched in like the prices we're paying now or the prices we're stuck paying, that may be the case. You got to realize over time though, like if cheese, eggs, all these things are more expensive right now by 30% than they were a year ago, and say eggs used to be $1.50, now they're $2 for a dozen. I know that's cheap. Say they're $2 for a dozen, and they used to be $1.50. That's a 33% increase, 33.3% increase. If you have that and egg prices stay at $2 for a full year, so for the whole year, you're saying, God damn it, these eggs are $2. They used to be $1.50. Now every time I come in here, they're $2, and it stays like that for a whole year. And that starts now in October. By next October, the inflation of eggs will be 0% year over year. Because even though they're still high, even though they're still $2 and they used to be $1.50, there hasn't been any year over year inflation. So if inflation is entrenched in that sense, you just need it to actually stay the current price and not keep inflating. And eventually that will get reflected in CPI. Probably not what you want to hear. I wouldn't say it's entrenched to the point where we're going to see 8% year over year inflation forever. If so, compounding, that would be bad news for us, right? Things would get expensive real quick. CPI, I think we're seeing the flaws here. Okay, here's what makes zero sense to me. We live in a world, 2022, millions, I don't even know if this is true, we'll say thousands of data points coming out every single day. Financial data points, right? How many people, are spending money on credit card, how much volume trading the SPY, you name it. Probably millions, actually, now that I'm thinking about it, in the world of different data points when it comes to financial. We look at CPI, which is a lagging indicator, once a month to look at inflation. Why is that our best way of looking at inflation? Why couldn't there be a real live up-to-date tracker, like of what people are paying for gas and at the grocery stores every single day, that showed us where inflation was? Because my hunch is that when you look at things that are forward-looking, like commodity prices, like the cost of shipping, like all these things are going down to the point where a lot of economists are pointing to these, that, hey, look, the Fed should be looking at the price of shipping freight from China to the U.S. or something, because, hey, guess what? That was one of the things, or lumber back in July of 2020 or whatever. Like these things that we pointed at for, oh my God, look at inflation, look at the price of shipping. Let's try to find it. I don't even know. What's the shipping cost index? I don't know what the hell it was called. Freight rate index, the Freightos Baltic. So yeah, let's look at this. This back in September 2021, so almost a year ago exactly, this thing was at its highs, and it was before we got really crazy CPI reports and whatnot. And just so we're clear on what we're looking at here, this chart is the price of what it costs to ship. I don't even know. The only ISO compliant container freight index. So I don't know, just shipping, global container freight. So how much container is to ship something across the sea or whatever, this was one of the things that we were pointing to, saying like, oh my God, inflation's crazy. Look, it costs $11,000 to pay for a shipping thing. Well, guess what? That's gone to $350 now, or $3,500. It's come crashing down. If you're looking at a chart like this, which by the way, can be a good indicator of demand as well. You know, you hear consumer demand for goods and whatnot was off the charts, and that's come crashing down. You could argue the Fed could look at this and see this as a forward-looking indicator for inflation, whereas the CPI is lagging. Again, PPI, other kind of potential forward-looking things. The question becomes, does that, if the company ends up paying less in shipping or production or whatever, does that price end up getting passed down to the customer? We shall see. Used cars are now down 10% year to date. Yeah, you're seeing areas certainly where you have prices coming down. The question is it enough to offset the areas where prices are A, going up, or B, remain high? And those areas are right now energy, not just gas in terms of filling up gas for your car, but also paying your power bill, things like that. And also rent. We need more chickens. I actually saw chicken wings. Chicken wings, one of those things that people were pointing to that, oh my God, inflation's so crazy. Chicken wings price, you know, whatever. Chicken wings are actually are now cheaper than what they were pre-COVID. Yeah, add that to the list. Energy, food, and rent. I bet food prices would come down in America real quick if like the people that needed to the most started eating like 10% less than they usually do. Food prices would that'd be a win-win for everyone. It could be like the most problematic or most hated thing I've said on the show. But I think it would be a win-win for everyone. The situation is people will adapt and change buying habits like steaks. I go into the store, it's priced at they can eat it. I'm not buying at that price. Yeah, ask your boss how much it costs to ship to Germany. We haven't really seen gas prices were moving up. You can see here. Current average $3.87 a gallon. Yesterday $3.88, so down a cent overnight. A week ago $3.92, so down a week on a week over week basis, up on a month over month basis. So certainly for a while, gas prices was one of the main drivers of CPI being really high. I don't think that's really the case anymore. McD testing D-nut. Oh my, prob better than a plant burger. Is AB reading his inflation is over speech? No, I wasn't saying that. It will be really funny though when eventually inflation comes down and we can say, hey, everyone that was saying inflation transitory, it was transitory, is right. There's no time frame for transitory. Transitory just means like the D's inventory is low. Drought hasn't helped food prices. Yeah, I think I honestly think I think I think from a political standpoint, it makes the most sense to frame something like climate change in economic terms. And we've seen that before. Like I think like Goldman Sachs or someone came out with a report that said the like global cost of the increased natural disasters with climate change is going to be like $20 billion on the US GDP over the next, and I think the more because it becomes to me like it becomes something that's a lot more objective and a lot less like arguable when you're talking about the economic impact of something rather than like the political, virtue signaling impacts, right? Because who wouldn't get if you had like 10 if you had all did these different experts from banks from data science, whatever, and they all said that okay, this is going to cost us X amount of money as a country by not doing this, and you still said, okay, we're going to do that anyway just to try to score political points or whatever, then I think people would be able to see through that. And I think the more you try to kind of, we dumb down the argument based on like, this side, that side. Ensuring coastal housing going up, up, up. If you look at, it's not even just insurance, it is insurance in terms of like properties in Florida and stuff. Insurance is getting crazy. You also have in Florida specifically, after that building collapsed, and this is coming anecdotally from my friend who's actually looking around at AB. You think people read? Yikes! Not here, Ron. Oh, you weren't talking to me. Some people call me Ron. I think because like Aaron, Ron, I guess. So I see that you're talking about a different Ron. I don't know. I guess that is kind of frustrating. But anyway, I hear anecdotally that in Florida specifically, and I think kind of ramifications in other places, after that building collapsed in Miami, insurance for like condo buildings and whatnot has gone up a lot. I was reading once when a guy messaged me that it's cute you read. That is cute. Oh, Shelly, I also saw that you tweeted earlier today that today was a free money day. Well, how are you making free money today? We like free money on this show. You should share with the audience. Share with the class. Again, not to get I don't know what this kind of popped in my head because it's like tangentially related to the example where we were talking about climate change. From an economic standpoint, talking about the economic ramifications of climate change, talking about that instead of the political kind of bullshit. I've seen that argument made for police brutality the same, and I think that makes a lot of sense there, because what you have now is you have certain police departments, like say the Chicago Police Department, I think was the number one, or maybe LA, of like police departments that have to pay out a certain amount in wrongful arrest or wrongful, like injury lawsuits each year. And right now, you would think like the free market, economic thing would be like, okay, if you get, X amount of dollars lost to the police department each year, you get fined or you lose this amount, you're done, you're fired. But that's not what happens, because you have like the police unions that have all the power in the world to come in and say, oh no, even though we had to pay $1 million in this wrongful, injury lawsuit, he's a cop and we're going to back him with all our lawyers and shit. So if you want to fire him, you got to fight the union, and then they don't. So in that way, the union's actually getting in the way of what would be like a free market approach, where the economic, I guess free market type solution would be like, hey, take all the guesswork out of it. If we have to pay money in a lawsuit or pay X amount of money, like boom, you're done. You're considered a liability, not an asset. And like I said, it takes a kind of a lot of guesswork at it. Again, I think framing it in an economic way that makes it objective, people can understand it. Okay, you're costing taxpayers dollars at this point. It's not about, psychology or race or anything like that, I think it makes more sense. No one shares their money printer, Ron. Okay, Shelly, look, if you've got some good Forex arbitrage trade, where this is a nice, good community. We're not going to front run you. We're not gonna, blow your spot up. I mean, I think that's part of it, certainly, where, like, obviously you're not going to have, there was a case, I don't know if you guys saw this, there was a headline the other day where LAPD officer was testifying against, or he was preparing to testify against other LAPD officers, and they beat him to death in a training exercise. I think that's true, but I think it's more, at least in the United States, about specifically the police unions and how much, like, power they're able to have in terms of protecting, protecting people that probably shouldn't be protected. I did see a Twitter thread the other day of someone who, like, someone was asking, like, what's your favorite household brand name that's a sub-billion-dollar market cap? Which is actually a great question. It's really hard to think about. A household brand name, so a name that, like, everyone would know, like Kellogg's, that's under $1 billion. And someone, like, replied to the thread, like, I have the name, but I'm not gonna give it to you until I buy a certain amount of shares. And someone's like, do you really think fucking dropping the stock name on this Twitter thread is gonna change the stock price? Pizza, Krispies, cereal, chicken tendy, crisp cereal, burger, pop cereal, etc. New business model for the upcoming repeated. Zen bullish. I mean, you're not wrong that if there's a 1929 type crash, there's probably money to be made in some areas. Probably not a lot of money to be made, but if you can look back and see what came out of the Great Depression, what did well, right? Try to recreate that. Maybe spam. I don't really know. Like the food spam. Oh, holy shit. I didn't realize who was that? Jay Rice? Jay Rice in the chat talking about, was that you talking about McDonald's and Krispy Kreme? I didn't realize they were actually doing that. McDonald's is actually why? I'm confused. I feel like this would be bad for McDonald's. Here, we're gonna get my Benzinga Pro pulled back up. So McDonald's is actually gonna start selling Krispy Kreme donuts. Okay, hear me out. First of all, I know McDonald's has already tried a few times to, they have their apple pies, they have like cinnamon rolls and stuff. I don't know how popular they are. I know for a while they tried to have like donut sticks. I hate how much, like, I know all this, but I know because I go to McDonald's, honestly, way more than I should. But here's where I'm confused. All right, let's go to our news. Krispy Kreme stock surges as McDonald's start test selling. McDonald's has sold Krispy Kreme donuts at some locations. All right, so here's what I don't understand. Oh, the stock's coming down. Hellas, Krispy Kreme's is. This is a good buying opportunity for D-Nut. I'll tell you right now. Stock got up to $14, back down to 13. All right, hear me out. If someone goes to McDonald's, like, oh no, is that what they're gonna be doing? There's no way. Oh, a Krispy Kreme like McFlurry, that could be kind of fire. But here's what I'm thinking. I'm thinking if they're just selling straight up Krispy Kreme donuts, like as part of their breakfast, additionally, I feel like that's bad for McDonald's because whatever McDonald's McDonald's has a very, very good very good vertical integration, right? Like everything they like buy their own potatoes, all this stuff. So their profit margins for selling like an egg McMuffin is probably amazing. It probably costs them like 10 cents to make, and they sell it for like $1.50 or whatever. There's no way their profit margins are going to be as good selling Krispy Kreme. I mean, it's McDonald's, so obviously, like they did their due diligence and it made sense. Whatever price range they're able to get the donuts at from Krispy Kreme, it probably makes sense for them to do so. I think my point is it'll probably end up taking away, like if someone was going to go to McDonald's and buy 2 egg McMuffins, both of the profit margins being very strong for McDonald's for both those egg McMuffins, and now instead someone's going to get 1 egg McMuffin and 1 Krispy Kreme donut, and the profit margin is not going to be good. Like I wouldn't get how that makes sense. Wow, Melanie, very very mature of you. Soda is the big money maker for fast food. I know like a McDonald's or fast foods make a lot of money off the sodas because, you know, they buy the syrup in bulk. They hit it on the drink machine when they fill a cup like this, right? The biggest expense is the cup, and it's like 5 cents, and they sell a soda for like $1, $2. I haven't seen the math or like the data broken down, but I'd be curious to see what like how much of McDonald's, say, total revenue comes from soft drinks, because I would actually say it's probably not that much. Well, let me rephrase that. Like, how much McDonald's makes a year in soft drinks is probably in like the millions, if not billions. But I doubt it's like 50% of McDonald's profit comes from soft drinks. You know, like I'd guess without looking at all of it, it's less than 1/4%. I have no clue though. This is 100% true though. For any like restaurant, even like medium to kind of upscale restaurants, right? Like I used to work, I was a waiter for one at a restaurant in college where like, you know, it was like a nicer, not like super nice, but nicer like Italian type restaurant. Like you'd go there with when your parents were in town, get like a pasta salad with, you know, a bottle of wine or whatever, and the bills were like reasonable. But that was something our owners talked about all the time, was that like if you sell someone a $15 burger, the restaurant might be making like $3 or $4 from that based on like what they on input costs and how much you paid for the burger. You sell someone a $15 glass of wine, the bar's making like $12 on that. Reworked at an Olive Garden. Right. I'm not saying that soda's not McDonald's highest profit margin or highest profit option. I'm sure it is, like percentage wise. They make more profit off a cup of soda than a Big Mac, but I think I think McDonald's still makes more money off its food than soda. No, the restaurant I worked at was called Sophia's in Columbia, Missouri. I don't had a falling out with the owners, so if you go to Columbia, you go to like Murray's or one of their competing restaurants. They also own and operate Addison's, but it's I would say it's if you think Olive Garden, but like if it was actually nice and a local spot and not like a chain, then you're in the right direction. Growing up, I legitimately thought like Olive Garden or Red Lobster were like really nice restaurants. I did work at a Red Lobster though, after Sophia's, and Red Lobster and Olive Garden are basically, I would put on the same level. Used to be owned by the same company. I think Darden used to own Red Lobster, not anymore. Did you like working at Mickey's? I've never worked at a McDonald's. I know that was Jeff Bezos' first job, so maybe I should get a job at McDonald's and see how that. Dude, yeah, especially at it's crazy to me, like I forget where I was, but like depending on where you are, like if you're in like Nashville or New Orleans or like a really touristy spot where people know they can really jack up drink prices, like I remember there was one time I was out with a bunch of friends and someone ordered like 6 Fireball shots, and they were like $6 a piece. And I remember the bartender like poured them all in front of us, and so the Fireball like fifth went from full to halfway full for 6 shots or whatever. And at the end, it was like $36, and then like with the tip. And I remember thinking in my head, like, buying in bulk, they probably legitimately bought this Fireball for $5, had the whole bottle covered in one shot. This is crazy profit margins, really crazy. Andio said he worked at a burger place. I was really bad at upselling. Yeah, upselling, actually good. I will say being a waiter was good practice because you are kind of a salesperson. You talk to a bunch of people like every shift, so you get really comfortable just talking to random people. Here was my biggest tip that I got waiting tables, and I guess this was applicable to like my restaurant, probably other restaurants too. But I would get asked for wine recommendations a lot, and I was like a 20-year-old college kid who knew nothing about wine. Or people would be like, so a couple different tips. One is I would go to the bartender and get different samples, and that showed them that I care. I was very, like, they loved that I then came back with like 4 different little free sips of wine. They're like, oh my God, you know, you're such a nice little kid, like going out and running me, getting all these different samples. The other side of that is then they will pick something they like based off of the taste. And then once you get them that glass, they're never going to be unhappy with it, right? They're not going to be unhappy with a glass of wine that they chose and they picked out, as opposed to if I said, oh yeah, get this one, and then they get it and don't end up liking it. But what I would do, the other tip, was that say we had 3 different like Sauvignon Blancs, which is the most popular kind of red wine to get. And so people would always ask between the 3, or maybe, or no, I think it was 3 different kinds of Pinot Noir. Yeah, 3 different kinds of Pinot Noirs maybe. And they would always ask between the 3. And like one was a $8 glass, one was a $12 glass, and one was like a $14 glass. And obviously, if I recommended the $14 glass every time, they'd be like, oh, this guy's just recommending the most expensive. Like, that's easy to 3 out. No, oh, did I say Sauvignon Blanc? I meant Cab Sauv. I meant Cab Sauv. Cabernet Sauvignon, or whatever it's called. Anyway, it was a red wine. I didn't mean Cab, or I didn't mean Blanc. Anyway, point was, I would always recommend the middle one, the $12 one, because then they'd be like, oh, this guy's really honest. He's not just recommending the most expensive one, but I also wasn't recommending the cheapest one. So then they'd get a $12 glass of wine, which is actually pretty pricey, right? Because most people then will get 2, and then they're looking at $24. I don't know. I forget. I'm not a big wine guy. I'm like Dan White from Twitter. Not a big wine guy. That's what Kevin's for. All right, guys. That's 1:01 p.m. That'll be a wrap for us today. Sorry for saying the wrong kind of wine. I don't know what you want me to say there. But tonight, got Netflix earnings. Tomorrow, we've got Tesla earnings. Oh, tomorrow. Almost forgot. Tomorrow, almost forgot. Boot camp. We've got a great boot camp plan tomorrow, with a whole list of great guests. Let me go ahead and get that pulled up right now. I know off the top of my head, we will have Tim Quast there, Options Mike there, the guys from CEO Watchlist, Eric ES Invests from Twitter, who we've had on the show before. We'll have different sponsors from NASDAQ, from Schaefer's, live trading with me, Mitch Hotch, Ryan Faluna, Zunaid. I can't wait. This is your time, chance in the boot camp to really master different trading strategies, learn things that, you know, it's going to be a day where instead of talking about news of the day, what's moving stocks, we're going to be talking about different strategies, different portfolio management, things like that. So without further ado, let's go ahead, bump over to Money Mitch. We'll be back again with the boot camp tomorrow. We'll be back on Benzinga Live on Thursday. And till then, happy trading. Stay green. Give me a shout on Twitter at AaronBree5. Love you guys, each and every one of you out there. Yes, even you, Shelly. So again, stay green. We'll be back. Peace, guys.
This is Benzinga Live.